Hello everyone. Recently, I came across a lot of articles and videos about the similarity between 1929 state and the present state, like stock bubble, AA bubble, crypto bubble, and gold bubble, etc. I already made a video about my view regarding gold. Hence, in this video, I like to talk about the rest of the stuff. We'll discuss two things. First, what actually happened in 1929, the numbers and the reasons. Second, the similarities between the 1920s and 2020s, three key factors that are looking similar. So at the end of this video, at least we will have some perspective on where we stand in this market cycle and when I believe this AA bubble will burst. Hence, without delay, let's get started. First, what actually happened in 1929? Let's look at the number comparison. In 1921, Dow Jones was trading at 63. That in 1929, just 7 years, it increased by more than 600%. Not 60%, 600%. To put that in perspective, from 2017 to 2025, S&P 500 increased by around 200%, which is still a lot but nowhere close to 600%. In 1929, people were allowed to invest long time in the borrowed money. For example, they put only 10% of their own money, whereas they borrow the remaining 90%. So when stock prices fell even a little, they lost everything and had to sell, which pushed the prices down further. And at that time, it was gold standard, meaning whatever the dollar the US government print, it had to be backed by actual gold in the vault. So central banks couldn't just print more money to rescue the economy like they do today. Hence, when the crash happened, there was no safety net. Prices collapsed and hence it turned into the Great Depression. In addition, then the Fed actually tightened the monetary policy in 1928 to 29, which made the things even more worse. So the combined gold standard and the market correction turned into a global depression. Today, there is a key structural difference in the monetary flexibility of the central banks across the world. They don't need to print money based on the gold standard. Rather, they can print money based on the productivity of the people. Hence, with the help of the government, they can boost the economy and also at the same time, they could reduce the inflation. This is why a full 1929 style depression is unlikely, but that doesn't mean we are safe from crashes. Now let's look at the similarities. Despite the structural difference I just mentioned, there are three factors that are harshly similar between both decades, which I read in NDTV Profit article. 1. Public emotional investing. In the late 1920s in US, stock prices tables were printed every day in the newspaper front page. Think for a second, front page of the newspaper, which people always prefer the flash news. Hence, back then for the general public, everyday stock price is the flash news. Now, in comparison, today the setup is more sophisticated but fundamentally the same. Social media's algorithms always amplifying the fear of missing out content. For example, if I make a video with a title and content about market crash, then that video will do better compared to a positive videos. So in a way, people are constantly exposing to the speculation chatter. And in addition, it's all about the hyped topics and fear of missing out content. Last 3-4 years ago, they just talked about crypto. Last 2 years, all about only AI. And 6 months, it's just about gold. Hence, the psychology is exactly the same, just the tools have changed. Second, revolutionary technology hype. In the 1920s, people genuinely believed they were living in a technological golden age. First time electricity reached all the homes, mass production of automobiles began, aviation boomed, and radio brought entertainment worldwide. See, then there was a company called Radio Corporation of America, started only in 1919 and they never paid a dividend. That company's stock price was 5.8 US dollar in 1920. That increased to 586 US dollar in September 1929, which by December 1929 fell all the way down to 20 US dollar per share, and by 1931 it fell further to 10 US dollar. So, how radio was to the 1920s people, artificial intelligence is to the 2020s. I mean, there is no doubt AI will create enormous value, but what's unclear is how these companies, the multitude of AI firms, data centers, and the connected ecosystem will actually going to make money. Just like radio stocks in 1929, AI stocks today are priced for perfection based on future promises, not current profits. Let me give you some specific numbers. The forward PE ratio of S&P 500 is at 22 times, which is above the 10-year average of 17 times. So I agree it's not crazy, but somewhat elevated. But if you look at US stock market, the seven largest companies driving most market gains over the last 2 years are all A related in some way. If you look at those AI focused companies like Nvidia, Microsoft, and Alphabet, they are trading at 40 to 50 times forward earnings. And here is the shocking part. These top 7 US tech companies now accounts for over 35% of the entire S&P 500's market value. To put that in perspective, even in 1929, the concentration wasn't this extreme. So in some ways, today's market is even more concentrated than 1929. And all based on the promise regarding the productivity miracle, and nobody knows where and how the productivity miracle is going to happen. I mean, historically, when we look at electricity or computers, the macro level productivity gains came 10 to 15 years after the technology was adopted. So, on that basis, investors today are paying future prices for productivity that hasn't materialized yet. But I believe the productivity gains might happen in 20 or 25 years, not like the market betting it to happen in 10-15 years, just like the dot com revolution. Hence, the AI's bubble is not just financial, it's based on expectations that got the stringent time frame to materialize. So, here is where it gets interesting. The crypto bubble is driven by greed, people want quick returns. The AI bubble is driven by fear, fear of missing out, fear of falling behind competitors, etc. So, large companies are throwing billions into AI because they are worried about being left behind, even though they don't know what they are being left behind from. But just like crypto, when the money stops flowing in and when people realize there is no rate of return on AI investments in the short term, I think then this market will correct. Then the third, shifting in global order and rising debt. See, the 1920s was an inflection point. Globalization was on the rise but suddenly reversed after World War I. That period severely impacted the then incumbent power, the UK, which no longer wanted to polish the world. Meanwhile, US wasn't yet ready to step up and it took decades before it finally held the mantle. As a result, there was a genuine power struggle. Today it's similar. US is showing signs of weakness with their increasing debt and other problems, whereas China isn't ready to lead globally and most Western countries and India don't want China to lead. And hence, after 30 years of globalization, we are seeing all the economic nationalism like trade wars, chip wars, energy wars, etc. Hence, in a way, this diverts the government capital spending from productive sectors of the economy to the non productive sectors like crypto, AI, and military spending. So it seems we are stepping into a new world where US got comparatively less power, which creating some uncertainty and I have no idea how that will turn out. See, this is not the first time this is happening. In 1960 to 80s, Russia challenged US dominance and in 1990s, Japan challenged US dominance. And in those two attempts, US survived. So will they survive this China challenge this time? That I don't know. Anyway, to conclude, in my view, a 1929 style collapse may not happen, but we might have like a dot com bubble. The dot com bubble lasted for approximately 5 years from 1995 to its peak in March 2000, whereas it reached the low on October 2002. So I believe this AI bubble started in 2023, hence it might survive for another 2 to 3 years. Again, this is just my opinion and I could be completely wrong. So that's all in this video. Hope you got some useful information. Please consider subscribing the channel and liking the video so that it will help me beat the algorithm and also motivate me to do more. Please don't make any investment based on this, as I'm not a SEBI registered advisor. I'm doing this for me and viewers educational purpose only. Thanks for watching.